Hey everyone, George Christie here with Wine Industry Network. Welcome to another episode of our ongoing Bold Predictions webinar series. And today's titled the Bold Predictions 2026 Mid-Year Outlook. Now, for some of you that may be familiar with the Bold Predictions series, we typically do this similar style at the usually end of January, early February. We bring the same panel back every year to make their bold predictions. It's moderated by Damian Wilson, who's with Sonoma State. And this year we thought it might be kind of cool to do a mid-year version of it. There continues to be a lot more questions than answers. So that's what we decided to do. Luckily for us, we've got a terrific panel, beginning with Rob McMillan. He's the Executive Vice President and founder of the wine division at Silicon Valley Bank. And of course, if you're in the industry, you're familiar with the work that Rob does. He puts out the State of the Wine Industry report every year, as well as a direct-to-consumer report that comes out every year. And he's just a real authority on kind of what we're experiencing as an industry. He's going to be joined by Dr. Robert Eiler. Robert is a professor of economics at Sonoma State University. And I think what Robert does really well is help translate complex economic issues or theories, philosophies, and makes it really easy to digest it and relate it to what we're experiencing in our industry. So I'm super happy to have Robert join us. We've also got Glenn Proctor, who's a partner with Ciati. Most of you have probably heard Glenn speak at one conference or another, but Glenn is literally one of the leading experts on the grape and bulk wine industries and the economics behind that. And he's always got something really good to add. So we're happy to have Glenn with us. And finally, we've got Michelle Muth, who's a principal at Baker Tilly, who merged with Moss Adams. And what's really great about Michelle's perspective is that she and her company work with producers of all sizes. And so she's got an interesting insight into what some of the brands are doing differently, especially the successful ones versus others. So we're really happy to have Michelle join us today. Thank you in the audience for joining us. This is a really terrific conversation. I think you're going to really enjoy it. Well, thanks everyone for joining us today. I know you guys are super busy, so very much appreciate it. And yeah, I'm really looking forward to this conversation. Now, as we talked about in the intro, we do this bold predictions at the beginning of the year, but we thought it would be neat to do something mid-year. I think that it's no secret the industry is super hungry for any information that they can get. So we're going to experiment with this and see how everyone likes it. Robert, we're going to start with you. There's obviously a lot of uncertainty in the wine industry, but it's not constrained to just the wine industry. So can you talk about from a broader perspective what the country's experiencing out there with regard to just economic uncertainty?
Sure. I think the main way that you can characterize uncertainty is what's been happening with inflation and the consumer's reaction to it. On the small to sort of middle income side or lower to middle income side, we're seeing a little bit more of a contraction in consumption. We're on the high income side, we're not seeing as much. And I think you're seeing this sort of bifurcation of expectations because of that. And inflation then bleeds into interest rates. So if you think about interest rates as at least a part of the playground in which expectations play themselves out in financial markets, the lack of a descent in interest rates over the last, let's say, 6 to 8 months has got to be a function of more uncertainty being imputed in the economy. Though if you looked at our equity markets, you wouldn't think that in trend that there's a lot of uncertainty at all. So the game right now is to try to figure out what the tea leaves are telling us in terms of how the future is going to play. But I think that the uncertainty is just simply driven by costs of goods, and that's both for smaller businesses and for small or lower to middle income households, and how that affects higher income, let's say equity market participating households is still somewhat up in the air, but the data suggests that those households continue to sort of truck along as if they're just expecting good times rolling ahead. So it's a very kind of bizarre time. It's kind of what you call a K-shaped economy in that sense. But that's how I kind of watch what's happening with expectations. And I generally watch interest rates and prices.
So a lot of the conversation around what's happening with wine is shifted from cyclical to more of a structural change. Is that just specific to wine, or are you seeing that in other categories?
Well, in terms of structural change, I think that wine has stood out a little bit. You could say that cannabis has been through a structural change for some time in terms of another sort of regional product that is has a very long supply chain here in our region here in Sonoma and Napa counties. But it seems like it is somewhat distinct. I couldn't point to another industry that really seems like it's going through the same cycle at the same time. You could say that, let's say, hotels and hospitality more generally went through it on the other side of the pandemic and had to think about, does this mean we're going to have structural change as a result of this very sharp shock that looked like it was going to have a long tail? But that also somewhat cleaned itself up. What does remain, and this is just something to think about, is if you look at the long-term statistics on the amount of hiring in hospitality, it is still down below the pandemic level and one of the final industries in the United States that has not recovered and in fact is very far from recovering. So that's probably the one let's say, industry sector where you might say structural change has happened recently and looks like it's going to remain, but that primarily is on the hiring pattern, not necessarily on the demand pattern.
Interesting.
If that makes sense.
Yeah. You touched on this a little before, but I'm going to follow up with this. So some of the reports that we've seen with regard to wine is that in the luxury segment, say wines over $100 are outperforming the rest of the category. Is that something that you're seeing in other categories as well, or is that wine specific?
Well, in a kind of a related way, if you look at luxury hotel demand, we've actually seen that on the rise. And some of that, I think, is people still wanting to travel. There might be the final remnants of the shadow effect of the pandemic still out there. And where people are deriving either their current resources or betting on future resources to pay for it for luxury travel, they seem to be walking up the ladder in terms of travel. So longer haul trips, the willingness to stay at higher price and maybe more like spa-like hotels than you could think of sort of national and international chains. So the data on luxury travel, specifically to staying in luxury properties, seems to be on the rise simultaneously, which is somewhat intriguing, but then alludes to that idea I said before about the play out of a so-called K-shaped economy that and it may be just the expectation that not only for me am I not as exposed to the risk of things like marginally rising inflation. My supposition is my equity portfolio is going to clean it up, where not everybody on planet Earth has equity market participation.
Rob, talk just for a second for the audience. When you talk about a K-shaped, what does that mean?
K-shaped economy to an economist is basically where you see a consumption pattern that is split, where higher income, potentially higher wealth, but there's still a lot of research out there about how wealth bleeds into actual current consumption in terms of, let's say, final consumption goods and not consumption of durables or other services. It continues to rise while lower to middle income households start to decline in how much they're spending. And usually it's driven by some shock, like either higher interest rates or higher prices that are more regressive in terms of how they impact a household's decision-making, meaning that lower to middle income households are feeling more of that burden of those rising costs of getting through the day versus higher income and potentially higher wealth households that have more instruments by which they can buffer current costs rising. So that K-shape then starts to show its face in terms of the way that consumption is taking place.
Okay. So when kind of referring to at the lower level, like the lack of confidence, right? Consumer confidence. So what drives consumer confidence, and how long does it take, or what sort of things that have to happen for that confidence to increase?
Well, that's an amazing question.
Easy question.
There's probably 1 million pages of economic research written about what drives consumer confidence and ultimately consumer decision making. We generally measure it as economists by sentiment indices, where you're doing survey work and trying to get a sense of how people consumed today, how they intend to consume tomorrow, and what is driving some of those factors. It usually boils down to cost of credit, cost of goods, and their incomes, which it should not be a shocker. But how those blend and how they kind of walk parallel to each other, it has been the subject of hundreds of thousands of pages of research. But the bottom line is that we do those consumer confidence surveys because we believe that by taking a sampling of the population and asking them about how they are getting by today, but really how they foresee, let's say, 12 months in the distance, their ability to continue to consume and what's their confidence in being able to keep on or rise the level of, or the volume of their consumption levels, that tends to be relatively connected to what happens in consumption in terms of the actual data. The timing of that is also a huge issue in terms of trying to figure out, well, if I can use policy, like let's say interest rate policy, to affect the way consumer confidence works, does that not then lead to a growth in demand? And do you want to have, are you thinking there's a logical step there? The timing of that and the space between my change of expectations and my change of behavior is very tricky to pin down.
Yeah, super interesting. I want to go to Rob McMillan for a second now. Rob, bringing it back to wine, beyond the economy, what do you believe are some of the biggest forces that are reshaping our industry today?
But I think probably people are sick of hearing me talk about the rotation of consumers. They started talking about it in 2017 when they started seeing changes in the way we were, especially at retail, in volume segments. And so that's probably the major one. And then the other one that plays into it as well is the WHO and the things that they like to say and honestly make up. Recast sciences, marketing, really what they're doing. And that has some impact as well for health-conscious consumers.
Do you think that the majority of wineries have reached a point where they recognize it just simply isn't a downturn, but a fundamentally different marketplace?
Yeah, I do. I think my name was spelled MUD when I started to talk about this because the industry was still just going fine. And now I think, well, one of the things that I've said consistently is you can't fix a problem you're not able to accept or identify. And I think that we're finally well past that point where everybody's accepting and identifying. And now what we're seeing are people actually doing. So we're in that phase of correction where I think things are improving. But it starts with your point, which is, do people recognize it? And are they accepting it? This is not just a normal cycle. And I think the answer is yes.
Do you think, I feel like what we're seeing out there is that the wineries that are outperforming the category aren't necessarily doing things completely different, but they're thinking different, right? I mean, is that safe to say?
Yeah, kind of. We just finished we had the State of the Industry in January. Probably the thing that came out of that most was that we expected to see 2026 slow down in the level of decline, and then 2027-28 would be the bottom, probably in negative territory. More recently, we did the direct-to-consumer thing, and what we tried to do is separate the upper quartile from the lower quartile, hoping that we would find some secrets. The ones that are doing well. Are they doing well because they have, jumped on a spaceship and done something? I mean, what is the activity that they've done that's changing those outcomes? And I found a really interesting thing, which is everybody's doing the same thing, which is investing in the direct consumer segment. They're investing in the tasting room, particularly, whether that's making it prettier, or whether it's hiring more staff or training more staff, working on hospitality. It's all kind of the same sort of answers, no matter what your sales growth or decline is. What it really comes down to is those that are doing well are looking at the opportunity and they're seizing it. They're looking at the opportunity. It's not like a binary situation where we have visitors and then we don't have visitors. Right. We still have visitors and we still have consumers. Now the question is, how do we get those consumers? And the ones that are doing well, they are spending more time looking outward, and the ones that are not doing as well are spending more of their time cutting costs and kind of trying to right size from that side to balance out, the expense and the income, which everybody has to do. But if you're just focusing on that, you're not going to grow from cutting costs. That never happens. So you have to do both.
It's kind of it leads up to a question I want to ask you. In the DTC report, you talked about this idea of finding what's next. Right? Can you talk a little bit about that, or what you meant by that?
Yeah. I don't think people really grasp what I've been talking about, honestly. I've said that what we really need to do is take the experience on the road. And backing up into where we are right this second, that plays into the notion of, we have decline in the tasting room, and we've invested all this money in the tasting room that's going like this. It's kind of a down funnel. And what we really need to do is find a way to replace that lost revenue. For whatever reason, it's not being found in the tasting room. We've got to find a way to replace it. And it's not just in club membership. And so, this is the time where this is what I was hoping to find in the data is that, people have to think out of the box. We have to change what we're doing. We have to change not only what we're recognizing, for instance, why are people not coming to the tasting room? Or why are they not coming to my tasting room, even more particularly? So we have to change that. And then once we discover that, we find ways to adjust for it. And so one of the ideas that I've had, and I've mentioned it for at least a decade, is that we have to take the experience on the road, but we depended too much on the tasting room. And we need to spread that out a little bit. We need to find other income sources. And so just as an idea, I said, look, you take it on the road. And people kind of misunderstood that. And they said, well, we are doing that. We go into markets with drive-arounds with our distributors, and then we go to a country club and have a meal with our club members. And that's good. That's a start. But I'm talking about something a little more dramatic. I'm talking about finding the consumers where they are and bringing them into your tent, as you will. So, as an example, if you go to anywhere along the Rockies, whether it's Idaho or whether it's Colorado or even down into Arizona, what you find are consumers that have more discretionary income and that are younger. And those consumers are actually showing a predilection for more spending. They have a better lifestyle, and so that's where the opportunity exists. And if it was me, what I would do if I was running a winery right now is I would get 5 of my friends together, and I would go create a wine, let's call it a wine ghetto for lack of a better term, in Phoenix or Denver or something like that. But a destination place where I could actually have people come to experience. So that is taking the experience on the road. And and then sharing in that information that people get when you have everybody coming. You have a stage, you have a grass thing, you have some hospitality things that are driven into a place, and so you can rotate kind of like a pop-up, an extensive pop-up, if you will. But that's an example of the things that I'm talking about out of the box.
Yeah, that's interesting. You mentioned a little bit earlier about seeing some signs of stabilization here in 2026. What sort of things are you looking for in particular over the next 12 months that tells you we're starting to really turn a corner?
Well, we are. And so I look at the supply chain. I start with the grower, I go to the producer, and then I go to distribution and direct to consumer, and then I go to the retail side of things. And it doesn't matter where you look. If you go back 12 months, and then you look at where we are in the last, let's just say, 13 weeks, whether that's retail, whether it's SIP-source data, almost anywhere you look, what you're seeing are things aren't as bad as they were. So it is growing. It's not declining as quick as it was, and that's what you really are looking for, any sort of a bottoming in a model. You're looking for things, instead of going straight like this, you're looking for things to just kind of even out just a little bit, and we're hitting that point now. So to the extent that I was able to come up with a forecast that said that this year is going to be negative, but less negative. That seems to be happening, whether it's growers, just across the board. Inventories are coming more, just growers inventories are coming more into balance. I'm sure Glenn will have some observations about that in a minute. But whether it's producer, whether it's grower, whether it's wholesale, everything seems to be improving. And the nice thing is that, to me anyways, that the wholesalers aren't shoving stuff into the retail channel. So the wholesalers are looking a little bit worse than the retail channel at this point. But the good news is that they're dealing with their issues rather than just shoving it down into retail, because we don't see a change in this coming until retail starts to turn positive, and we're still looking for that.
Okay, well, that's a good segue to Glenn. So Glenn, given the state of today's grape and bulk wine market, from your perspective, what does that tell us where we're heading?
Well, I mean, I think there's a lot of stuff great group of speakers, so nice to be included. And I think I just listened to Robert just talking about, change of expectations kind of versus change of behavior, right? And so I would say in this market, we haven't seen change of behavior in how people look at supply, right? And I think, are we headed to some bottoming? I think we are, but I think it's hard to figure out when, where, why, and how. I call it, how's the plane going to land, and how is it going to take off again? And I think that's a challenge. When we look at inventories right now, we sit at close, I think this month, 39 million gallons. That has consistently been higher than 12 months prior when we look at that on a rolling basis, at least over the last 2 years. Usually we see a dip in some of that inventory. Around this time is when people reload when they're looking at the next vintage. We haven't seen those adjustments yet, what I would call fast enough to indicate that on a supply side things have changed yet. Now, I agree with Rob that I think the telltale sign that driving this is sales, and that's the cure, right? Is some kind of stability, whatever that stability is. It could be declining at 2% versus 6% or 7%. So I think we haven't seen that well enough, and I continue to see wineries out putting their limited dollars into, which I think is probably the right vein, into the front of the house, moving product, repositioning, reinvesting, and really not putting many resources back into the supply side because the assumption is I'll be able to get it if I want it. So we're still seeing that there's supply issues there. I think also as Rob said, we're addressing some of the distributor issues that we've had, but I think that distributor disruption has made everything a little harder to predict. And I think this question that Robert made about uncertainty really becomes where a lot of us are. If we look 6 to 12 months into the future, what does that look like? And how do I position myself? But one of the challenges I'm seeing is you have to survive to that point to be able to participate. So we are seeing growers, wineries, we are seeing, it appears, those that will not make it through, or at least it's a question, how will that play its way out? I think structurally we are making changes on supply. We think we removed about 40,000 acres last year. We think we're going to remove 40 to 50,000 acres this year when some of the data is looked at. I would say that 2 or 3 years ago, the supply structural adjustments were in the valley. The valley, in terms of the Central Valley, is ahead of the coast in terms of supply adjustments. Just this last year, we've seen people on the coast, which includes Napa and Sonoma, starting to make some removals or structural adjustments. But I think we still have a ways to go before we kind of get back to a balanced marketplace. And the one thing we've seen, it does look like this year the crop's a little lighter, or it appears to be, but that hasn't caused anybody to change behavior. There's been a little grape activity, but I think everybody still feels pretty comfortable with, I'm not going to go chase any supply. I just don't need it, which you'd almost think, you sure about that? Because at some point this will change and you will need that supply. But I also think the other thing, and we should talk about this, is credit and cash are extremely tight. And so what we're seeing to survive this is somebody's got to have money. And the banks are limiting risk. You've got buyers limiting risk. You've got growers or suppliers trying to figure out, am I the bank because nobody's paying me? So I do think with a lot of these things we're trying to do and be prepared, you've got to have some financial foundation to make some of these changes. Otherwise, you are kind of in a survival mode and you're just doing whatever you can to kind of get to the next 6 to 12 months. So it's an interesting time, but I do agree that we're getting closer to this point where we've removed enough to balance out. We're gonna remove too much. I'm very sure of that. And at some point, we're going to go, we've removed enough, even with a decline in sales, we're going to catch that and probably pass it, right? And that'll be an interesting thing we've talked about this, and I think Rob talked about, this, in managing this, you need sustainable downturn management, right? So that you're balancing caution with your long-term vision. So how can you do that? We do see people that are what I call this defensive overcorrection. They've cut everything, but long-term, that business probably won't be there, right? It's more of how do I get out with the least loss? And there's people looking at those options. And I think there's others that are trying to invest in what this new reality will be.
So as we start to emerge out of this, with all the vineyards that have been removed, are there certain regions you kind of go, they're never going to be vineyards again?
Yeah, I mean, I think you see that when demand was growing, again, the thing we need to realize for those of us that have gray hair is that, in the early 90s till 2018, as Rob kind of mentioned, we were growing at 2.5% to 3% as an overall wine category. That cures a lot of supply ills. So I think, we kind of need that growth to come back to really get to a point. But I see that as we move through this, we are going to come back to a balanced position going forward. I just think the question is we're going to be a lot smaller. And so that means by definition, George, that you're going to have not all those vineyards are going to be replanted. The one thing that's interesting, if you go into that, because this is what people are trying to look at, if it's not a vineyard, what is it?
Right.
Right. And then the other question is, what is it worth? So in some areas, I was talking to somebody in Napa, everybody bought the vineyards at $300,000 and $400,000 an acre. Well, all of a sudden, if grapes aren't grown there, what is it worth? So there's some kind of recalibration of values that's going to come into play here as we kind of work through recovery. We have seen in certain regions other things like almonds going north where there's water on the central coast. I've got guys doing olives, just talked to somebody doing lemons, row crops. We don't have that type of other commodity production, I think, here in the North Coast. There's some solar going in, my understanding, on a couple projects instead of vineyards. But I think the other thing is we need to realize in this whole thing is some of the areas that we thought were immune aren't. So like I was talking to a long-term winery grower in Napa, and he goes, yeah, I don't think we should have grapes in Carneros. Now, he didn't happen to have any vineyards in Carneros, but that was an area you go back that, so it's going to be this question about where should vineyards be, and it's across the board. And then the other question I think we're going to see is efficiencies, right? So if I've got 3 tons an acre, it's hard to see how you're going to survive in any kind of reset of these values. So you're going, that's, I think, where this question, it's people are really looking efficiency, value, and the economics more on this new reality, which means, if I get 3 tons and get 15,000 an acre, or 15,000 a ton, there's a small reality of that, don't get me wrong, but it's not a large pool to play in. So I think that's this whole adjustment.
Well, it's funny, you're like the third person that talked about the people considering solar out there where vineyards used to be. And I think did a little bit of research. That's a little bit of a slippery slope for some of these growers who were thinking about going in that direction, but that'll be interesting to see if that comes to fruition. The other day we were chatting and we were talking about the state of the bulk market and how much older bulk wine is out there. And you mentioned that there are wineries that have never done non-vintage releases who are starting to either head in that direction or they're seriously thinking about, I can't sell this bulk wine from a vintage or 2 vintages ago. We're going to blend it up. Is that like a one-off, or is that a real conversation that you're starting to have more often?
I think it's a real conversation. I mean, we were trying to look at, when we do look at that inventory and break it out, what we can show is that on a composite basis of, let's say like Cabernet, only 25% of what we're showing of this 13, 14 million gallons is 25 vintage. So all of a sudden, there's 23 and 24. And you can make the argument, okay, there's less current vintage. People have made adjustments. The supply is going to skew toward older vintages, right? And the question is, are they merchantable? Are they even have value? So I raised that with a few wineries as we pitched this, and they're looking at me going, maybe. So because and they're going, hey, there's people looking at non-vintage, and we're seeing people look at non-vintage even higher price points. And I think what that is going to do. So let's say I'm holding vintage. I've got some people we've got a lot of 2023 wine out there. I mean, so I think there's some wineries that are putting 5% of that for the next 10 years into something, right? To kind of work through that inventory. I think others are going, hey, if the consumer's not requiring it, there's an argument. Can you make better wines? You can blend, maturity, all this we've heard over this history but we're seeing that. And I think if more of that happens, it probably means a little more of that inventory we're seeing is relevant for a little while longer, right? Mm-hmm. So it probably means you can keep going back to that well a little longer than worrying about, I need 26 vintage right now. And I think that's the thing we're trying to understand as we go forward. So it is an interesting question. I mean, I think the other, question we need to look at too is as people, that's one way you can get cost, right? And there's a consumer at some level that's saying, I want affordability too in our wines. So by doing that, you can play with costs. And the other thing I think in the reality of the future is we've seen a lot of people vacate coastal appellations and go to California appellations, to blended appellations, whatever you want to call it. And I think that devalues to some degree the coastal appellations. And as this comes back, I think what we really need to get some foundation, because the cost structure is different, right? In terms of cost of farming, is we need, some Sonoma County brands. We need some Mendocino. We need some Monterey. We need some consumer value in those regions that I think are going to support the growing and the making of the product from those regions. Otherwise, potentially it goes to the lowest common denominator.
Yeah, that's interesting. Michelle, I want to switch to you now. You and your company work with wineries of all sizes. As you look kind of across your client base, what are the healthiest businesses doing differently?
Yeah, so I'd first like to say, the industry contracting or stabilizing, it sounds like bad news, but it doesn't necessarily have to be. So from the internal winery perspective, growth that comes with declining margins or higher carrying costs, I mean, that's not good in any situation. So, the most successful wineries are really the ones that are not, they're not just reacting to what's happening in the market, but they're really intentionally shaping their business around where the market is going. They're super disciplined. They know which brands and channels deserve their investment and attention, and they know when to say no. So they're stepping away from this habit of making decisions based on tradition, or that's how we've always done it mentality, and really starting to make decisions based on data. They're also really willing to make difficult decisions early, so addressing inventory issues, managing costs proactively, and making intentional and intelligent investment in areas that position them for long-term success.
Well, talk a little bit more about that. I want to follow up with so can you be a little more specific in where you're seeing your successful clients investing versus others?
Yeah, so one area that they're looking at is, like in periods of growth, a lot of wineries are focused on investing in, capital projects or new brands or things like that. What we're seeing now is leadership taking a step back and looking a little bit more internally about what technology can we utilize in our business to help us make better, faster decisions. How can we streamline things? How can we automate things? Those types of decisions.
Are you seeing some of your successful clients leaning more into AI as to helping them make some of these decisions? And can you talk a little bit about that?
Yeah, I'd love to talk about AI. So I think most are using it in some capacity, but in fairly practical ways. So they're using it to draft content, summarize meetings, help with customer communication, making employees more effective. So right now we're kind of in this stage, experimentation through practical adoption. I still think that we have yet to see real transformation. So it has the potential to improve things like, forecasting, planning, inventory optimization, customer insight, financial analysis. And these are all areas where better information will lead to better decisions. But I don't yet think we're in full adoption mode. I think going forward, the most successful wineries are the ones who will really embrace this transformation. They'll adopt a real AI strategy, they'll invest dollars, and it'll become part of their culture.
Yeah, interesting. When you look ahead, what's your biggest concern about how the companies you're working with are preparing for the future?
Yeah, I think my biggest concern is that there's like so much going on right now, and people are so focused on today's challenges that we're not really preparing for the opportunity ahead. So, there's pressures around demand, margins, valuation, capital. And if these companies delay these investments in technology and development in their people and development in their customer relationships and really understanding what the consumers are telling them, I think that they're going to be further behind when the market recovers.
Yeah. I think that for some of the smarter folks that are out there that are preparing for success, there's also a lot of human talent that's become available, right? With all the layoffs and things of that nature. I know there's some really talented people out there that are up for grabs, and it'll be interesting to see how that area unfolds as well.
Yeah, and I think with the adoption of AI, that's something that I think a lot of people are concerned about, but it will allow us to really focus on those things that create more value and use that kind of higher level talent to our advantage.
Yeah. So Michelle, I'm going to start with you. I want to get into our kind of bold predictions, right? So I've asked each one of you to think about making a bold prediction of how you see things unfolding over the next 12 to 18 months. And so Michelle, I'll start with you. What's your bold prediction?
Yeah, I think a year from now, we're going to be talking a lot more about how wine companies have reinvented how they operate. So the businesses that succeed won't necessarily be the ones with the biggest brands or the highest production. They might be, but they'll really be the ones who became more disciplined, more data-driven, and more willing to adapt. So my bold prediction is that in the next year, we're going to see the real competitive advantage in this industry is agility and not necessarily scale.
What do you think, panel? What do you guys think about that one?
I think that's great. I really like it. Yeah.
Any other comments on Michelle's bold prediction?
You can't win on scale, right? I mean, that used to kind of be the model. So you got to be better than everybody else. So yeah, it's great.
I think what that does, though, is it kind of tells a story about where the shakeups are going to take place. So where scale already exists, there might be more risk exposure as a result of that versus being smaller, higher value, strong niche, where there's a strong flow of visitors that kind of provide you with those other revenue lanes in the short term. It'll be very intriguing how it shakes out along those lines.
Rob, anything to add?
Yeah, I think that where we're headed is kind of obvious, and I like Michelle's point of view is that it aligns with mine, which is that we understand their problem and we're finding ways to get out ahead of those. The ones that are still kind of stuck looking inward, are going to be the ones probably that fail. And somebody else said, I think that it's kind of the tale of two cities, if you will, because in order to get this back into shape, we either have to increase demand, which so far we've been able to collaborate efficiently enough, effectively enough to do, or we have to right-size supply and everything underneath that. And so what I've been saying is, look, we need fewer acres, we need fewer producers, and for God's sakes, we need fewer bankers. So I throw all of it into the...
Always need fewer bankers and lawyers, but yeah, keep going.
Yeah. So, but the whole industry has to right size. And so, there's two things happening right now, and this is going to carry forward, through the next year, 2.5 years, if not two, where we are going to have a bifurcated look at things. You're going to have that upper quartile successful, which, I show right now are growing at about 11%. And then, the lower percentile, the lower quartile right now is growing at, is shrinking at 6. So we're going to see more of that. And we're going to see the, opportunity for those folks that are doing the things that Michelle was talking about. And then what we're going to read in the papers are that somebody went through bankruptcy, that somebody failed, or somebody was foreclosed upon. And that's part of the healing process, as ugly as that is. That's got to happen too. And so, back to some of the stuff that Glenn was talking about, this industry is quite resilient. We hold our water. we are used to just kind of waiting out cycles. And so my greatest fear, if I have one, is that people make the mistake of thinking, well, this is going to come back next year and it'll be like it was in 2019 in terms of sales. Yeah. And that's not going to happen. So if you were waiting things out instead of trying to actually maximize your return by exiting, you're making a financial mistake. But you've got to rationalize and figure out which side of that thing you're on. So change, it's positive, is going to happen. We're going to have leaders. We're going to start to see some things that go forward that we can all start to adopt, I believe. And at the same time, what we read in the paper is going to be ugly.
Yeah, that's a good point. All right, Glenn, your turn. What's your bold prediction for the next 12 to 18 months?
Well, I think I think it's a good point, right? Where we are going to see more pain here in the near term. But my belief is that in the next 12 to 18 months, we're going to see capital come back into the industry. Right now, you look at some of the deals that are available, vineyards and wineries you could purchase, right? Because certain people are looking to exit. Yeah. And a lot of you're going, hey, there's no buyer out there. So your exit strategy is, how do you get out from under your debt? I mean, it's a little gruesome if that's you in or you out question, I think that Rob raised. So I do think in the next year, we're going to start to see opportunities will be looked at and money will come back in and say, okay, I can see long-term value in this, and I'm going to buy a vineyard, buy a winery, come back in. Now, it doesn't mean everything's great, but it means at the cost of what they can buy that for, they're going to see that as a sound or a place to put their money. Right now, we're just not seeing cash come into the industry. That's why everything's so tight. So I think that'll start to loosen up. Now, I don't know who's going to be that investor, but I think we'll be at a position where we can start to say, okay, I can see the future, and I still think there's value in this business, which is kind of hard to get to right now.
Well, I hope you're right, because it just takes that first person to kind of make a move before people start to chase them. Any comments or feedback on Glenn's bold prediction?
I think he's right. We do have to see capital, and I see people that are on the sideline. This is a point in the bottoming phase where you start to have those that are kind of circling and waiting, for the price to come down. Yeah. The ones that actually jump in now or very soon are going to be the ones that have the opportunity to get the properties that are going to have the greatest upside. And those that wait won't. And so that timing is already starting to happen. That kind of a dance is already starting to concern. So that's the beginning of what Glenn's talking about. And I totally agree with what he's saying. We will have more capital coming into the market. At the same time, we're going to have capital exiting.
Yeah. Interesting. Robert, I'm going to go to you now. Your turn. Do you have your bold prediction for us for next 12 to 18 months?
Yeah, I mean, I think folks kind of ate up a lot of what I was thinking about in terms of that agility piece and where you're going to see the shift in capital. I mean, my bold prediction is that it's going to get sort of eye-popping worse before it gets better in terms of the public. You're going to see some brands probably change that you thought were stalwart and would be here forever, just because that shift, that final convulsion has to kind of happen before the next phase takes place. But that's a lot more on the negative side. on the positive side, if you just look at what's happening in the Bay Area broadly, especially around AI, in terms of the wealth that's starting to be built up and the comeback of San Francisco, for Sonoma and Napa County specifically, you might get a real buffering agent in terms of having people flowing toward Napa and Sonoma who have now come from God knows where into San Francisco and kind of into a 20-mile radius around the city, who are looking for weekend trips and have higher incomes or wealth that they're willing to spend, that were not in, like, let's say, the short drive marketplace before that. So it'll be intriguing to watch how wineries think about lowering prices, trying to provide some gateway products that will kind of adjust inventory at the same time of trying to get longer term customer base back and shift them in toward DTC. So I think some of that you're going to start to feel that I don't think there's going to be as much downward pressure in Napa and Sonoma in terms of the foot traffic, but I think there's going to be some pressure to really adjust the way you think about how you service tasting room visitors and what the price of products and visits are going to be over the next 12 or 18 months, just simply to kind of turn a corner.
Yeah, interesting. Any comments for Robert?
No, I think it makes sense. I do think that, the foot traffic and, how I think a lot of wineries in some of the more premium areas, they've relied on DTC as their, that's been their margin. That's been their kind of, and it's interesting to see them move over even to try to get into the 3-tier because they have volume issues, right? Which is tough because everybody's trying to do that right now to move products. So I think there is this, I really like this thought, entry level product. I think we need to do that for our whole industry, but even at this higher tier, entry level products that then support that DTC growth and bring you into the fold. I think that kind of investment, a little bit what Rob was talking about, is really how entities are going to survive, right? Yeah. I mean, the customer and that relationship is still going to be, what's going to get us farthest.
Yeah. Well, and for example, will you take that bulk wine that's like, let's say, Howell Mountain, that's been sitting there, and now let's stuff it into a non-vintage Howell Mountain with the idea that, we don't want to lose brand and the brand equity, but we got to get something moving just to move the bulk wine off the market and also try to bring people toward those higher price points. Glenn, I have to say, at the end of the day, what you've been talking about the last few months in terms of that gigantic surplus, that to me is kind of the existential issue. How is that going to get liquidated, literally and figuratively? And what's it mean for the industry on the other side? Well,
and I think it's how are people going to deal with it? Can you take the loss? How do you protect brand equity, right? Because nobody, especially at a higher brand value, you don't want to discount, right? You can never get that back. A lot of that, it's interesting, probably the most active buyers we're seeing right now are private label buyers. They're then packaging the premium appellations, sticking it into retail in some made up brand. And I don't know, I mean, we've got a smart group here, but I look at it as this whole thing about appellation and value. They're using the appellation of most of anybody, right? And here's, you can get this at, whatever, $19, which used to be X. And it's there. You can see a Alexander Valley this. Does that actually help the consumer at a more approachable price point see the value in those appellations? And as we come out of this, does that help another winery reestablish an Alexander Valley? So I think that's what I'm trying to understand, because that would actually bring value back to some of the premium areas too. But it's because those are the people that are using it and buying it. Now, you're taking the shorts to try to sell through that way if you're the supplier, but it is interesting to watch. I think that whole transition is going to be interesting.
That is interesting. Rob McMillan, let's finish with you. What's your bold predictions for the next 12 to 18 months?
When you're talking about averages in this industry right now, you're making a mistake, because things aren't averaged. You have winners, you have losers, you have high production, you have low production, you have premium pricing, you have value pricing, and each of those segments deal with things in a different way. You go back to Rob Eiler's comments about the consumer. The upper level consumer, the K-shaped economy, they're doing well. Lower consumers that have issues with the groceries, as an example, aren't. And you're seeing that happen in the the retail side with the under $12 categories, matching up with that other side of that visual curve. So we are, as an industry, we're in the better place if we're selling in the premium categories. I like what Glenn was talking about in terms of what's happening with the premium wine that's out there now, and that is going into private label. That's an on-ramp. And I've been talking about wine ramp. You got to go back to 2019 to listen to that story. But wine ramp and on-ramp, that's the key, is that on-ramp. So how do we on-ramp new consumers? And so instead of actually giving it to the private label guys, is how do I, as a producer, sell that in some sort of way, whether that's shrinking size, whether that's creating a new label that's in here that I actually have a QR code on that somebody can snap and they can learn a few things. How do I get that consumer back into my front room, if you will, so that they're not just going off as a one-time activity? And that's some of the learning we have to. I think Michelle was talking about some of that as well.
Yeah. Well, this has been a really interesting conversation. I think that the common thread is people that are winning are adapting, they're changing, they're evolving. I like to think that when we do come out of the other end of this, and I know it's going to be, the industry is going to look a little different. I think we're going to be proud of some of the things that we were able to accomplish. Some of the things that we embraced to do and are doing differently. And I think that we're going to start to see the emergence of the next generation of industry leaders start to grab a gear. And I think that's really important. So I want to thank you guys for your time today. Michelle, Rob, Robert, Glenn. Again, I know how busy you guys are, but I thought this was really interesting. I think our audience is going to love it. So thank you.
Thank you all.
Thank you very much. Appreciate it.
Well, I hope you enjoyed that conversation. I know I certainly did. It was a real privilege for me to be able to moderate a panel with such high quality industry folks. I want to thank Rob McMillan, Dr. Robert Eiler, Glenn Proctor, and Michelle Muth for taking the time to be with us, to share their thoughts and share their bold predictions. And we're going to see if we can get them to come back next year. We'll revisit some of those predictions. And certainly I want to thank Protea Financial Wine Accountants. They are our sponsor for the Bold Prediction series. And it's their support that allows us to continue to offer up great content like this to our audience for free. So once again, thank you. Thanks to our panel, and thanks to Protea Financial. We hope to see you again soon. Make sure you like our YouTube channel. We'll keep you posted on upcoming episodes.